Hey, good afternoon, everybody. Mitt Goblish at Comstock Investments with the brokerage trading team here in Royal, Iowa. And today I'm going to give it's going to be a relatively short webinar on Marketing 101. And the approach is going to be not to tell you from a specific quantitative or measurable standpoint how to market, but I'm just going to give you an infrastructure with a couple of basic platforms by which to link some things together. It'll give you some ideas when and how to market. And it's not going to be ag specific or any sector specific, but simply going to provide some concepts. So what I'm going to do is we'll go to a PowerPoint. I may come back and speak a little bit, or we may just go through the PowerPoint and you'll hear me be able to talk through some of those dynamics. So what we're going to talk about, Marketing 101, and the approach I want to take on it. I want us to consider that if you're listening to the webinar, all of you are kind of blocked in and bundled into the same concept, and that is you're a commercial unit that's marketing something. And by that, I mean you're producing something that's generating you a revenue, and that revenue potentially has an opportunity to give some risk infrastructure by which the price of the asset may go up or down. Okay, so there's a couple of things I'd like to talk about today. One is one platform that we're going to look at. The first one would be what I call the balance sheet, and by that I mean your cash balance sheet, your risk balance sheet, and your opportunity to repaper or get or enhance contributions to that revenue that you're generating. The second part of that would be what I would call the profit and loss management opportunity in marketing. And there you can see what I would kind of bundle together and say, okay, you've got this overall general macro production environment. What are the critical parameters there? You've got your cost infrastructure environment within your P&L. What are your parameters there? And then you've got this break even or contribution requirement, quantifiable, measurable requirement that you have the end game, and you have the critical parameters there. So this assumes that we're all going to produce something that has price asset volatility or variability, and we're looking at optimizing our revenue at the end of the game. What are those critical linkages I see? I see a critical linkage between what I call the balance sheet, that bundled balance sheet opportunity, and whatever your cost parameters are within your P&L and the critical areas on that. I'm sorry the one doesn't show up too well on the right-hand side of the page, but that's just a reiteration. So you see those two platforms that I would like to start out and use as the foundations, what I want to talk here. Balance sheet and then your P&L. Let's go back in just a second. I want to talk real briefly in very general terms about a balance sheet. I hope most of you've seen either this report, not this particular report from R.J. O'Brien, but maybe you've sensed the commitment of traders report and look at that as a viable mechanic by which balance sheets can be looked at in a little bit different way. So I quickly want to talk about the three circles that you see on the screen. And let's go from left to right. A producer merchant, I'm assuming for the sake of this discussion in this webinar, the commercial merchant is somebody that produces the product, okay? The swap dealers and the managed money are people that put their money basis either looking at valued assets, either overinflated or underinflated, overvalued or undervalued, and hence they invest passive investing in those opportunities, which we would consider either shorting the market or going long the marketplace. So why am I talking about this on the balance sheet? Because you see last week, based on the commitment of traders report we got last Friday, said that the corn sector added 103 long contracts to their overall bundle, their repertoire of positions. And in a flip side, the swap dealers and managed money added about the same amount of shorts. So what happened there? What happened was the corn had a balance sheet. They sold out their cash side and they got covered their short positions on the cash with long positions. Now, let's not try to over confuse that. Let's go through, and I'll talk about that in a little more layman's terms, but I wanted you to get the idea in the big picture, what the big ball of wax was doing in terms of the balance sheet. So let's look at an agriculture producer, and it doesn't have to be an agriculture producer. It can be a commercial producer of everything. You're producing a product, and as a result of that, you're ultimately going to sell that product. So you're very sensitive on the revenue side. So your objective on the balance sheet, on the cash versus the risk balance sheet, is to protect your revenue side, to protect that product sales price or ultimate eventual sales price from reducing down to a point where it starts to impact your P&L. So what do? If you're a producer, in very layman's term, your cash balance sheet, you produce something, be it corn or gold or cattle or whatever it is. You have something that you're going to go put at the end of the day in your freezer or inventory or in a silo or wherever it is. So you're long that product. So your risk balance sheet has to have a short residual and opposite effect. When you generate your revenue and sell that production, which we just saw on the screen before for the trader ratios, then you liquidate and you're short that cash side, and then you replace your short risk position with a long, and that's exactly what we saw on the commitment of traders. Okay, the private money, the managed money, the swap funds, the wholesalers, they finance the cash side to sell their product and hence liquidate their risk side. So those two are equal at the end of the day. As you're producing the product, you have one position, your long cash, short risk. And as you generate your revenue and liquidate your product, you short your balance sheet and you're long your risk. And just keep that simple and try not to read too much into it for the time being. A manufacturer, on the other hand, still has the production side of the business, but they also have the procurement. So their sense is I've got to protect my costs coming in and protect my revenue on the way out. So you're looking at exactly the same, except you got two legs on that stool rather than one. So think of an ethanol plant. They're buying corn and selling gasoline, or they're buying natural gas and selling DDGs. They have a little more complex and moving parts. They have more moving parts in their balance sheet, but it works out exactly the same. So given all that, what really is the platforms here that you should be looking at when you're commercially trying to market your product? And I'm not saying market at a specific level, but if you look at that P&L side that we talked about the cost, the environment of the critical costs, and where you're going to focus on as marketing your product, and as you're moving through and looking at liquidating your balance sheet. The most important aspect, in my opinion, on your marketing is you've got to get some critical parameters around your break even that link directly back to your building and liquidation of the balance sheet. So you take those critical break even parameters, the critical contribution parameters, maybe it's 325 or 330 on corn, cash back to you. Maybe it's $2,300 on gold. Maybe it's on the mini S&P. Whatever that critical return contribution baseline is, you've got to work your balance sheet, your cash, and your risk balance sheets back to give you a contribution back to your bottom line P&L. And it might take another step in terms of liquidating your production into revenue by doing what we call repapering. But those are the critical things. So if you look at the right hand of the screen, you've got to properly build your balance sheet. You have critical revenue and purchase timing. In the case of a straightaway producer, your revenue timing where your liquidation is critical. And then you've got to look at enhanced contributions back to what the end game was. And that's the way I'd kind of summarize that. So number one, you look at your balance sheet. You got to tie your what makes sense for you and your business unit, the cash side of your balance sheet to the risk side of your balance sheet to protect your revenue the best you can. And secondly, you've got to pick within your P&L or your cash flow environment where exactly your critical points are and where you want to put more focus or less focus in terms of your risk balance sheet. And you've got to tie that together to your critical revenue execution and liquidation. That timing has to be critical, not to the marketplace essentially or necessarily, but what it works back into your system. And then you look at enhanced contributions in terms of what both the cash and the risk environment will give you. So that's the way that I would look at Marketing 101. So you say, well, what the heck do I do? What am I supposed to do? And I would say, just looked at that optimization approach, as I would call it, where you take your balance sheet, you link your balance sheet, your cash balance sheet, your risk balance sheet, and then you create infrastructure that says, these are the critical points I have to get within my cost and cash flow infrastructure by which to execute my revenue that I'm protecting through risk approaches. I have to protect that, and the timing has to be paramount to liquidate that, to get it back. And if I miss the boat a little bit, then I have to look at additional enhancements and additional contributions with repapering or the likes of that to get that back. So what you have to do with those items is you have to generate revenue, but you also have to protect that. And that protection has to go, that generation. And you see those aren't they're not diverging arrows, they're converging arrows. And that's the way that I see it, it has to happen. So thank you for that. And you know where to reach us at Comstock Investments. And I would honor any questions that anybody that got to take a look at this, whether you like that approach to Marketing 101 or whether you don't. But I think it's a good way to look at what some platforms are. You can tailor those platforms to what you need. Look at your balance sheet, your cash balance sheet. Look at your risk balance sheet. Look at your P&L and cash flow. Link those two together. Make sure your timing is appropriate, and that critical timing has to go back directly to what your key financial return parameters are. And if you're not going to reach those in some cases, then look at using some other risk management opportunities by which you're going to get back to what those needs are. And that's not trying to guess what the market is or trying to make money necessarily off one side or the other side in terms of the linkages, but that's the way I would see it. So thank you for your time. I look forward, if there are any questions, you can reach us at Comstock Investments. Good day to you all, and thank you for your time and your consideration.